Eric Muathe, Muathe.com, with part 1 of this weekend's market analysis video for the weekend of September 9th and September 10th, 2017. Let's take a look at markets here, and we begin by taking a look at a snapshot. Market's been trading for about an hour and a half. So we have about 5 hours to go before the close of Friday's session. Let's take a look at those charts. Let's begin with the Nasdaq Weekly, and here we can see that with a down week, we are now back below the breakout level, and for the Nasdaq, that level is 6387.75, which goes back to the weekly closing high right there. We did close above that. There was a breakout last week, but now it looks like if we are trading below that number, then this looks like early signs of a failed breakout. In other words, anything below this number is a failed breakout, and we know that failed breakouts are notorious for taking markets lower. So this is a number to watch. Anything below this is an indication of running out of momentum and potential evidence of the markets wanting to move lower. If the Nasdaq can reclaim this number, then the bulls are still in control. That's a simple way of looking at it. Now we can also see that as of right now, the market did make an improvement to all-time weekly closing highs, but this came at the expense of the technicals. So that is definite negative divergence, or in other words, the technicals did not follow through. That is not a good move to new highs. This generally suggests that there's going to be a pullback in place. So we continue watching this line for more evidence that this is running out of momentum with that negative divergence. There's also another way we can look at this, and it is the previous support line. If we draw it this way, you can see it connects the lows here, here, and here. But now what has happened is we broke below that level, which is this movement lower, and now we come back and we fail to hold or reclaim the level above that. So as long as we are seeing this rejection on the Nasdaq, that's another visual sign that the market could actually be setting up to move lower, as long as this is still the case. So that's the bearish argument. Now if you take a look at the 3-year weekly for the Nasdaq, the previous chart was the 2-year weekly. Here we can see there's a line we've been watching for support, and you can see that we broke out here, which is this entry. Nice entry on hindsight. Market comes back to test the same line, which is this re-entry back to new highs. We bounce back above the line, which is this re-entry back to new highs. We bounce back above the line, which is this re-entry back to new highs. So we can also say that as long as the Nasdaq is holding above this line, all pullbacks are shallow. So we shall see. In other words, if there's going to be a major correction, then the market will have to break below this line, something we haven't done yet. Let's take a look at the Nasdaq daily, and on the daily we can see another failed daily breakout. In other words, there was an attempt to break out past the previous daily closing high from July, and that level that we were watching was at 6422.75. So this is a failed breakout. Until the Nasdaq can reclaim this level, we can assume that this is a market that is now poised for a pullback. All right. Also, we can see that there is this line that the market responded to. We hit that line and we pull back as of the last couple of days. So we hit that level, resistance there, off the highs there. So the market stalling over the last couple of days is consistent with that resistance line on the Nasdaq. And we can also logically assume that if you take the daily closing low there and this daily closing low, that until we break this trend line here, most market participants will not panic. So that's another layer of saying, or another way of saying, the market should be sideways to down based on the current chart settings, But until we break this line here, the market continues to be stable, if not outright, let's say, bullish. Now, unlike the Nasdaq, the Dow did not break out, even though we can say it came close to breaking out last week, but did not make it that far. So we can see here slight failed breakout attempt on the Dow. We also see that the Dow was rejected when it tried to move above 69.1. Now keep in mind, we've been trading above 69.1 and having a nice rally. We moved above 69.1 again here. We had a nice rally, and now we are seeing that this is being rejected. So that is setting the stage for a pullback of some sorts. But just like we saw with the Nasdaq, on the Dow, if we take a look at 3 years of weekly data, there's a line that the Dow would need to break if this market is to start pulling back seriously. So you can see that this was the breakout level here, which is this week, and we've been using that same line for support. Market has been bullish throughout this phase. Support here, which is this re-entry. We came close here, which is this re-entry. So as long as the Dow is holding above the same line, we can say that the Dow is sideways to bullish. At some point, should we break below that line, that's when we could start expecting a bigger correction to the downside. So right now we are still above that blue line. Market should be sideways to bullish. If we take a look at the Dow Daily, we can all see that the Dow is doing its best to find support at the 50-day moving average. So it's been bouncing on the 50-day moving average, which is a sign of a stable market. Also, we can draw a line connecting RSI lows going back 1 year. Should be something like that. And it comes, and we can see the market did find support right here over the last couple of days. As of right now, the market is moving above RSI 50 for the day. The more it stays above RSI 50, what that means is that we should expect a confirmed up day, maybe a close at the highs of the day, as long as the RSI is above 50. Also, there's another way we can look at this, which is this movement here in November. The market moved above this range, and we haven't looked back since then. So we take that information and draw our uniformity line. And the idea here is every time we bounce on this line, there should be a swing trade to the upside. Double bottom uniform activity support during those lows. Uniform activity support for that re-entry. Uniform activity support for that re-entry. And over the last couple of days, this past week, the market held that line, so which is another entry based on that line. So as long as the Dow is also holding above this line, that's a stable to bullish market. If we take a look at the Dow hourly, we can see the chart that I was discussing during the past week has come in play. In other words, this line here was the break line. And if you go back to last weekend's video, this is what we were talking about, that the market was coming back to test that line here. And as of last week, we ended right there on that line. The speculation was that the market would find resistance and pull back, which is exactly what happened this past week. Also, we can see right now the market has formed an RSI support line here. And as a side note, interestingly enough, this line happens to be parallel to the previous line I just drew. So right now we can say hour to hour, as long as we are bouncing on this line, the market is finding support where it needs to find support, and it still continues to be sideways to bullish. Let's take a look at the S&P 500 weekly, and like we saw with the Nasdaq, we can say that the S&P 500 is showing a failed weekly breakout, which is not a good sign. And the level to watch there is it needed to stay above 2476.83, which is going back to this weekly closing high. So on a price to price basis, that's a failed breakout. That only sensitizes us to the idea, that was a mouthful, that we are seeing a market that is showing a week-to-week improvement, a failed breakout, and now we see that there is negative divergence because the technicals made a lower high while the market was trying to break out. That type of negative divergence generally is what sets the stage for a major pullback, or at least a serious pullback. So that's something to watch. It's another way of saying that as long as the S&P 500 is trading below this number, we can still be looking for opportunities to short the market because of the failed breakout. If it can reclaim this number, then the bulls would have corrected this mistake. Ultimately, there is a line connecting RSI lows going back about 2 years, and as long as this line is holding, S&P 500 still remains in a sideways to bullish market. At some point, should we break below that line, that's when we can still really start looking for lower prices in most of the securities that trade in step with the stock market, generally speaking. Also, on the daily for the S&P 500, we can see that there was an attempt to break out, and that breakout as of right now has stalled. So that's another failed breakout, and the level we were watching there for a breakout was it needed to stay above 248.0.91, going back to this daily closing high right there. So as long as it is below that price, in other words, as long as the daily is failing to break out, we can still expect the market to be under some pressure. Don't forget that we also did try to make an improvement to new highs here, but that came at the expense of the technicals, which were confirming a resistance line. As you can see, we hit that line as of the end of last week, and beginning this week, the market did respond by pulling back. On the S&P 500 hourly, just like the Dow, we can see that there's a line developing here showing support. As long as this line is holding, yet again, we see evidence that the market continues to be sideways to bullish. At the same time, if we take a look at the 5-minute chart for the S&P 500 for Friday's trading, we can see that as of right now, when the Dow was up, I think about 60 points, the market hit that level, and now we seem to be pulling back. So hour to hour, maybe this is the high for the day. We shall see how it shall go. So show you what the market is doing right now. That's the snapshot of what the market is doing, and keep in mind on the 5-minute chart, we see that the market is showing resistance based on the 5-minute chart right there. And again, as long as this line is showing resistance, maybe we've seen the highs for Friday's trading. So what's the conclusion? The conclusion here is we have to also consider the monthly chart, and as we've been observing for 2017, as long as the monthly charts for the Nasdaq, the Dow, and the S&P 500, which is what I'm showing here, as long as the RSI is above 69.1, that's a sign of a market that we can consider to be sideways to bullish. And a good evidence of this was this period here. For 2 years, the S&P 500 remained above 69.1 from 2013 all the way to 2015. So just remember that within this period where the RSI on the monthly is above 69.1, yes, there's going to be pullbacks, but they tend to be shallow. So until we move back below 69.1, net, we can assume that this market continues to be sideways to bullish. Yes, some things, for example, the S&P 500 weekly are showing failed breakouts. So maybe internally, the market is starting to lose strength. But until we see evidence shown on the monthly, the market net remains to be sideways to bullish. And maybe if you're looking for sectors to go short, you can look at sectors that have already broken down, and there are many sectors that we've been following that have been showing weakness based on their long-term monthly charts. Eric Muathe, Muathe.com. Be on the lookout for part 2 of this weekend's market analysis video. As always, good luck, peace, and blessings. EACS.